The Philippine peso hit another all-time low against the U.S. dollar after closing at 58.99 today. This is the local currency's worst performance against the greenback for the fifth straight trading day. The peso opened the day at 58.8, a drop from its 58.35 start last Friday. In an earlier briefing, Press Secretary Trixie Cruz Angeles said the palace is closely monitoring the peso-dollar exchange rate on a regular basis.
The International Monetary Board trimmed its growth forecast for the Philippines to 6.5% for 2022. That's lower than its initial 6.7% growth estimate. It is also at the lower end of government's 6.5 to 7.5% goal for this year. The IMF said the Philippines faces gloomier and more uncertain global environment despite having a fundamentally sound economy due to reforms and policies. Meanwhile, the IMF kept its growth forecast for the country for 2023 at 5%. Here to talk to us more about the impact of the weakening peso on the economy, we have with us One News Business Editor Regina Lay joining us via Zoom.
Hi, Reg.
Hi, Reg.
Hi, guys. Good evening.
So? What are we seeing for the peso? 60, we're practically there. 65, I mean, how much weaker can it get? Or how much stronger can it get?
It's like we started last week with what, 56, 57 or something, and now we're already touching 59 almost. So question is 60, 65? The short, painful answer is yes. Potentially we could be seeing 60. As you heard in the snippet earlier from President Marcos, this is a problem of a strong dollar, not the weak peso, meaning the reason we're depreciating so fast is because the USD just keeps getting stronger and stronger. And the reason for that is because their central bank, the Federal Reserve, just keeps hiking interest rates, right? Because why? They also have record high inflation. It's about, I think, 8.3% now. And the Fed is determined to bring it down to 2.2%. So you can only imagine how many more rate hikes that's going to entail, right? So again, given the trajectory that we're seeing, some of the analysts that we've spoken to say we could hit 60 levels within days, possibly as soon as tomorrow. Today, we closed at 58.99, as Sean just said. And 65, well, potentially by the end of the year, if the Fed keeps going at the rate it's going, although closer to Christmas, we are expecting a little bit of a relief because of the remittances from OFWs, but certainly it's heading there.
Right. Reg, right now, okay, as we all know, and as you would probably tell me, the central bank has a bunch of tools at its disposal. However, Governor Medalla has already said we're not going to employ so much of these tools right now because there's just no way they can keep up with the tightening of the Fed. They can't keep in lockstep with it because of the inflation that we are feeling here domestically as well. So what moves are available to the BSP at the moment? Do you think Governor Medalla will just let the peso find its true level? I mean, in Japan, they already interfered with the forex market.
Yes, that's right. That was big news, though, when Japan intervened in the forex markets. I don't think we're there yet. I think it'll be more the former, as you said, which is that he is happy to let the peso find its floor. That's going to be painful, of course, because yes, there's many tools that the Banco Central has, but the only real tool that they have is just like the Fed, is to hike interest rates, right? Now, the problem is that they can't go as fast as the Fed because remember, our economy only just reopened this year, right? So this is what they call a fragile recovery. Wala pa tayo sa pre-pandemic levels, even though the traffic in EDSA says otherwise. So bottom line is if the BSP, the Banco Central, hikes aggressively, there's every chance it could really hurt consumer spending, which is the driver of our economy. So beyond that, there's not much more they can do, but hope inflation in the U.S. calms down. And again, I think Governor Medalla is leaning towards letting the peso find its floor at the moment.
Okay, thanks, Reg. One News Business Editor Regina Lay.